to this talk on session brought to you by Ali Fahad and his amazing ability to coordinate everything and everyone in the room. And so what I wanted to sort of give a brief sort of introduction around what we're talking about today. Well, Kiyan and I always have this discussion quite a lot, but we generally like to think about what it takes to really be an emerging markets investor and see things in a bit more clarity around the ground realities that we're exposed to in these markets. So today we're going to be covering a whole bunch of questions around why we think emerging markets are a generational opportunity for any investor out there, why we think effectively that Pakistan is an opportunity whereby all the ingredients are there, but the coordination mechanism has an opportunity to be evaluated as well as improved upon to bring about super outcomes for the ecosystem. And of course, thirdly, just a little bit more around why we think that the way to go about venture capital in emerging markets is it's very different from what you would see a developed market VC do as well. So without further ado, let's get into it. So Kiyan, how are you doing today?
I'm good. I was just explaining to Ali and yourself beforehand, and probably contextually for the audience, that I've had my first child this week. I can't seem to shut up about it. Everyone I speak to, I have to mention it. But what that probably will entail is that I'm a little bit more optimistic or sentimental than I would usually be. So apologies in advance, but good.
Okay, so I think one sort of way to sort of start about exceptionality, and I think you've had everyone's had a pretty exceptional life being in the startup ecosystem, but I think there's always these sort of milestones which sort of really open your eyes to certain frontier markets and why you think they're exceptional and worth investing in. So if you were to sort of define the exceptionality of frontier markets, why it excites us to invest in them, how would you go about it?
Yeah, no, it's a good question, and the difficulty of always speaking about this stuff is you never know the context that your audience has, so you have to kind of set in place the foundations of why you think what you do, and then kind of just say what it is that you think. And I guess at least in my case, the kind of the story or whatever, the journey to try to understand that or come to that realization was a bit random, and I kind of came to the conclusion as to why I thought frontier markets just generally hadn't been done well before. But the starting premise was that an Iranian by ethnicity and born in the UK, and I would travel to the country a lot all the time. I mean, I'm fast forwarding here, I'm just kind of quickly summarizing. And what was abundantly clear was that the people of kind of my similar age, my cousins, my friends, were like as smart or if not smarter than me, but clearly it was obvious that by virtue of living in the UK, I just had a complete different opportunity set in terms of utilizing that ability. And that just didn't fundamentally seem right. And in parallel, for whatever reason, I really got into investing quite young. I liked the fact that it was kind of somewhat of a solo activity. All you had to do was study and think and act, and this was largely in the public markets. And all I cared about really was just how you would make money. And so I launched a fund, and kind of when I was around 17, 18, and raised a decent amount of money at the time. It was around kind of 3 million, which isn't an insignificant sum for someone that age, and just went about investing. And then within that, what was obvious was that there was this whole dynamic called emerging markets, right? Supposedly they were countries that were very fast growing, had good demographic dynamics, were underdeveloped in the sense that they hadn't built a similar level of infrastructure as you had seen in, let's say, the developed world. And here I use developed in the pure definition of GDP per capita. That's it. There's no kind of any of a definition of it. And that clearly would present a lot of investment opportunities, right? And that got me curious because I effectively put Iran in the bucket as kind of an emerging market, and intellectually I found like that as a concept very interesting. And then when you started studying it, what you largely saw was that most of the international firms that were trying to tackle emerging and frontier markets, by the way, that premise is very much true. It's that there just is an abundance of opportunities in these countries. I mean, we can speak about that separately, but just let's take that logic that premise is basically true. that most emerging market investors either were very good in terms of performance for a handful of years and then slowly died off, they were very cyclical, or they just got burnt because they did stupid stuff. And the stupid stuff I basically put in the category of not really understanding the reality of what they were doing. And they were using a completely wrong heuristic to try and capitalize on the nature of the opportunity set that they saw, which wasn't really what they saw because they just didn't have a proper understanding of it. And you then say, okay, well, what has been the 100-year success of an emerging or frontier market historically? And what you really have to look at is the local private sector that has actually existed in some minority. In that, what you've largely seen is kind of multi-generation businesses that have survived throughout economic cycles, and basically the playbook that they had ran over the decades is the country, because it's emerging in nature at any point in time, doesn't have everything that the world has the possibility to provide available to it, and so there's an opportunity for import export. You had traders, you had kind of old, and they inherently then, in parallels, when the country is developing a banking system, it needs to outsource capital to entrepreneurs to build out infrastructure. And so they typically got access to leverage, and in countries where inflation is high, that debt gets inflated away, so the cost is actually quite low. And as long as you could buy some form of operational asset that you could had pricing power above whatever inflation may be, basically you made in the hundreds of millions and in the billions over the past 20, 30 years. That's a playbook where if you look at any international investor operating in an emerging market, no one has really done. Beyond maybe some kind of second, third generation families, for example, British families that have been in Hong Kong for the past 70 years, because they operated like locals. They understood the nature of the game. So you look at the history of emerging and you say, well, if I was to be an industrial investor, I'm trying to deploy large amounts of capital, that probably is a strategy that makes sense, right? Consolidate local demand in fragmented supply by just being marginally a bit more efficient where the benchmark is quite low. Or you own assets where the country has somewhat of a comparative advantage in, i.e. it can export in the world and be a player in the world in. And by virtue of having USD revenues and local currency costs, you'll always make money irregardless of the economic cycle, okay? So that's kind of the first piece of, if you analyze emerging markets and say the premise is that they have a lot of opportunity, who has capitalized on that opportunity and what was their playbook? That's largely my conclusion. And I think that playbook holds true going forward. The other element is largely on the technology side, which is kind of, I guess, what this discussion is most related to, is that you say, okay, there's this interesting phenomenon going on in the world in the past 10, 15 years. All of a sudden, distribution I think is absolutely key. Philosophically, it's key because distribution is the value of any business. If you look around the world, you have many companies that have an average product but are fantastic at distribution, and they are kind of very significant multi-billion-dollar businesses. And in countries where offline distribution does not exist, without the exception of telecom operators. And I'm talking about distribution, I mean businesses that have the means to access millions of users, have interface with millions of users. And in the age of technology, where all of a sudden you have your country with 60, 70% smartphone penetration, and it happens to be that population is very young, a lot of interesting things are happening foundationally. One, that young, hungry population is accessing information and knowledge in a way that no generation has before. Their ability to synthesize and kind of develop knowledge and put it out to the world is kind of easier in a way that it never has been before. And that typically what these countries are suffering from is very large public sectors that have existed for a very long time and are entrenched. I don't judge it, it's the reality of what it is. And that is not an optimized economic capital and resource allocation system. And that because you can build distribution, it will mean that you then have a marginal cost base that is so low that you can build products very, very, very well and much better than what already exists in those markets. And if you can do that in a disciplined manner as it relates to how you build out the firm, how you all of this stuff that I'm sure we'll touch on, there are vast opportunities ahead of you. And so the first part of what I was discussing was what generally seems to work universally in these countries. The second part is what has to be the route for a lot of these countries for very many different reasons. And what I'm saying is not novel at all, because there's at least 24 emerging markets that, let's say, are a bit more developed, from China to Latin America and all of these places, where we already have the precedent of what's happening. Okay, Pakistan is very early in that journey, but I'm willing to debate anyone that says in 10 years technology infrastructure will not be much more meaningful than where it is today. I'd bet the house on that.
Yeah. If we were to sort of go into that point a little bit, right? I think we always discuss sort of how technology is generally evolving in terms of leapfrogging as well, right? So if you think about, smartphone penetration going from effectively, a POS machine acquiring to soft POSes, for example, right? Payments in themselves have become a lot more software-based rather than hardware-based. Why is it? And if you look at sort of POS penetration in Pakistan, it's quite low. And if you think about Iran, for example, inflation has sort of forced the hand for businesses and individuals to sort of move into digital payments quite retroactively, but also in a way which has led to Iran effectively having 7 million POS terminals, which, if you look at it on a per capita basis, is absolutely fantastic in terms of what the accessibility of the opportunity is. I think leapfrogging in itself, there are so many different technologies that we're looking at today in terms of cycles, right? So if you think about marginal efficiency, for example, we've got effectively AI that's supposed to bring that sort of higher level of marginal efficiency gains in a shorter amount of time. Now, if you think about a lot of the businesses that we're looking at in Pakistan, they're quite operational in nature. But I think one thing that founders have to embrace a lot more is generally the ability to really leverage these technology cycles and leapfrog what was available to a generation of founders before them. And I think being on the edge is not necessarily, we're not necessarily talking about building frontier technology, but what we are building effectively is marginal efficiency gains based technology that uses a tech stack that has evolved to match effectively what the most current premise for operational efficiency looks like, right? What do you think about that in terms of how do you think in terms of a lot of our companies that I think we had a pretty interesting discussion a few weeks ago or a month ago or so, where our founders effectively were looking at how do you integrate artificial intelligence or machine learning into effectively their DevOps, for example, right? How do you effectively make the coordination mechanism within the development cycle a lot more effective and efficient, so that you're not necessarily reliant on subpar talent, but that that you can effectively hire less, hire better, and generally build out faster with a lot more efficiency and margin of error in place as well.
Right. Yeah. I mean, I think you could simplify it a little bit by saying, again, I think the two vectors to look at when it comes to all of these countries is the distribution element. And the point there, I think, that is really important to understand is it's clearly, like in any market, you spend, you get users, right? Our experiences or our observation is that in all the areas, and the point is the market opportunities are just clear. I mean, you don't need a pitch deck to say efficient lending should be done on scale. Okay, it's very obvious. I get it. The point is how are you going about doing that? And it's all I think a lot of it is about understanding distribution and truly your playbook as it relates to distribution, and assume you are running it as if you're running a dashboard. You just it needs to be a seamless machine. You need to be able to kind of understand it inside out. So distribution is one vector. The other one is basically this old age concept of kind of bundling versus unbundling. The point being that if you look at a lot of the countries, and I don't think Pakistan is an exception, the average individual or company has to engage with a lot of different providers for different products. Right? There isn't kind of a consolidated player that can provide a broad range of services and products. And The reason distribution is important is that it allows you to build products at a much lower cost because you can distribute and extract more revenue from that distribution base that you have, that no other company has. So I simply see it as, I know what the market, you could be doing lending, you could be doing commerce in any particular different vertical. But what is your vector of attack for building distribution? To what extent do you truly understand the nature of the cohorts of the general population? And that's really what we're talking about here, because when you think about distribution, it's basically, especially in emerging markets, it's like a man walking blind.
Yep.
And you only realize the reality of what the population is until you touch it, right? But you need to be very systematic about how are you understanding the reality of what the general population of the country is in terms of average spend, credit data, all of this stuff. And this links to AI and remind me to come back to it. To really build out distribution in a way that no one else can. And the benchmark is not that high to do it because there are not a long list of companies that are thinking in this way.
Yep.
Okay. Now, clearly, that distribution has to be built off a product that has a real use case. And that is not a business that has 3 or 4 different products. It's one product, one real use case that is absolutely solving for, and it's solving for it very, very well. The pain point has to be real, right? And it has to do it more efficiently than anyone else does.
Yep.
Okay, to earn the right for that distribution. Okay.
Yeah.
The economic model of that product has to also be positive. I.e., there is no point burning a lot of money for a long period of time. You don't need to do it because you don't have an intensity of competition. So be very deliberate and patient about how you're executing it. And then understand how you can build more products on top of your distribution, because hopefully you have very high engagement, you have in a way that no other kind of distribution base in that country does. And that if you run that playbook quite well, that's kind of just already a very sizable business.
Mm-hmm. So I think,
and I would keep it as simple as that.
Yeah.
It's like, yeah.
Exactly. Like I like sort of think about it in terms of P&L, right? What is your customer's P&L after they engage with you or your service, and what is it before? If there's no effective gain on that P&L, really you're sort of really just reaching out towards a nice to have thing rather than I really need this in this ecosystem. I think customer experience is a little bit more complex. So you have to think about it from the perspective of utility, and that utility has to be clear and apparent. I think one of the biggest mistakes that a lot of startup founders do when they try and validate a problem is they largely look at penetration rates, right? But they don't necessarily see the trees around that low penetration rate. It's largely because there are some mitigating factors for that penetration rate to be so low, right?
Yep.
That there's an immense amount of friction that you don't necessarily have control over, and you don't necessarily, you would never nearly have enough resources to solve for. So I think,
I mean, you can think of it you can think of it more precisely in if you think about a lending business. So assume you have an underbanked country as I mean, just from data, Pakistan is for consumers, and you say, okay, my target is to build $100 million loan book in 5 years. Just that's simply what I'm trying to do. I'm optimizing for that. What you usually find is that 2 to 5 million of that potential 100 are just very good credit. They will always pay back. It's just the way it is, right? That it's kind of universal. It's kind of a weird law almost. The rest of it, you have no understanding of what their credit profile looks like. Okay, you're walking around guessing. You have to test it. You have to play around. You have to kind of till you build more confidence. That's what I mean when and at the end game is that takes a bit of a longer time to do, but you will get to your $100 million loan book. Why? Because there is no competition. But you will understand the nature of your business and the nature of the customers that you're targeting in a manner that no one else does. And to just kind of link it back to AI, the point on AI is there doesn't need to be a lot of kind of intellectual back and forth as to what it all means. What it simply means for emerging markets is most of data in countries in emerging markets sit analog.
yeah,
The job is of companies, people, whoever it is, get that analog data digital, structure it such that it can be fed into whatever the AI front end layer is. Okay, whatever the output of that will be very useful for the country. You don't need to be on the part of the kind of AI stack of, oh, we need to do the new open AI, whatever. No, just get your data and structure it.
Yeah.
Allow it to be synthesized objectively,
No,
because you've never had that experience before.
no, I think that sort of segues into some questions that quite a few people have, I think. So I think Rajiv from Dhaka, wow, a colleague from Bangladesh coming in, and I think this will segue into another question of ours pretty well, is that how do we sort of see the prop tech space in emerging markets, right? I think it's one of those unexplored spaces, but prop tech as an asset category or property as an asset category is one of the most, it's where most savings effectively go for
Yep.
players or for anyone in our market, to be honest.
Yep.
And if you think about it contextually, so in Dubai, for example, you can have a transaction close within 24 hours. In the UK, it takes a little bit longer. In most developed markets, it takes close to a week or so in terms of the registration process and all these sort of things. But in Pakistan and Bangladesh, it takes at least 20 to 30 days in order to close a transaction, right? And that's largely a mechanism of coordination between multiple stakeholders, be it the land registry department, be it effectively the local sort of development authority, be it effectively, just the banking required in order to facilitate the process.
Sure.
Now, let me sort of qualify all of that with also highlighting that this is a sector which is highly undocumented, right?
Yep.
So it's got a huge ton of analog data, but it also is a place where most people are not willing to effectively document their transactions. This is largely a function of either an inability for people to trust effectively their local government, or effectively an ability for people to do more nefarious things. But beyond that, I think it's also largely down to the headache of just most participants not being able to dictate how they'd like to do the transaction, because I think it's more of, this is a cultural norm and we need to do a transaction in a certain way, and that the seller is unwilling to sort of accept any other way which actually documents the transaction. So it's almost like a part of document transaction, right? In the sense that you've got like a nominal value, but then the real value is much higher, right? So I think that I think in my view, at least, it largely comes down to how structuring out a better governance system and a better land registry system in order to effectively document the transaction in a much more effective way. So that once that transaction is pretty much set to be documented, then you can sort of play around with how you need to fix the friction in between.
No, I understand what you're saying.
But if those nodes are completely like,
it's the prop tech sector actually in emerging markets is actually a fascinating one, because apart from EMPG, if I was to ask you which really big prop tech firm do you know in any emerging market, you probably wouldn't be able to say it off the top of your head, right? They're just not, they haven't been the standouts. They haven't been the standout players. And we actually for a period were invested in, I mean, we still are actually in the leading kind of vertical marketplace for real estate in Iran. And I'm sure listeners are aware of kind of what typically is going on. In phase one, you have the classifieds, which aggregate distribution and charge a rent on that distribution, right? It's quite a simple business model. And then they realize their biggest verticals are auto, real estate, and jobs. And then they say, hang on a second, I don't want to just charge a rent. I want to be part of the transaction. And so they all try to move into vertical marketplaces. My experience is that actually, I think what is going on is that the friction is not as high as you think.
Mhm.
Objectively, when you look at it, you're like, Jesus, this is a nightmare. I've got to run back and forth to different places. I've got to stamp 100 different things. I've got to try and speak to this person to convince them to do this today as opposed to tomorrow. As inefficient as that seems, I think it's not a huge pain point. And I tell you why, because it's just too damn difficult to build the distribution in the area that you need to. Beyond classifieds, classifieds do enough already, it seems to me. And I've seen there are a few companies that have tried to move on the transaction side themselves. They say, okay, we buy and sell property. Why? Because we have more data on both sides. I actually think probably the interesting line of attack is just do sales, right? If there's new developments, if there's new property being built, well, be the most efficient online sales arm. That way, you're going directly to the transaction. And you're monetizing the developer side because you're solving a pain point for them. It's not an obvious issue, but the point is, what is the most efficient line of attack? Right, you will make money in that model from day one. It's not the most glamorous one. You don't have a 50-person tech team, but you will build probably $5-10 million revenue business out of it, and
Mhm.
build some sort of network out of it, even if it's an offline network. That that's the way it's the problem. I think even with a lot of maybe founders is there are too many articles and online content on how all this stuff works in the US and Europe, which largely is very relevant in our markets, for the single fact that the competition dynamic is different, right?
Yep.
And that completely changes the nature of any sort of game theory, if you kind of like John Nash. Because
Yep.
if I have 10 competitors that are all well funded, i.e. if I'm operating in the US, all of them will have different fundraising, all are executing a different. My game is not a rational company building game. I'm not there saying I'm building a 30-year profitable enterprise. I'm
Mhm.
playing a game. I have to fucking outplay my competitors. But if you
Exactly.
if you had 1 million, 2 million ARR, the category leader probably already, because the country is so early in its digitalization path, right? And you then go and raise a 3-5 million round that gives you a balance sheet. It may not seem absolutely large, but it's still relative to your competition. You just dunk them. At that point, just be very deliberate. You don't have to do anything what you read about in Silicon Valley. Just do what seems right relative to the reality of the opportunity set in hand.
Yep.
That's it. That's just simply it.
Yeah. I think that sort of brings us a little bit quite nicely into something that I think we discuss a lot is investor activism and how it's so much more needed in emerging markets versus developed markets, where you have to sort of match up your ability to build a brain trust because just the problems are so much more complex in terms of just the asymmetry of information. So the more symmetry that you can build into the thinking pattern of the organization itself, it creates that sort of momentum or that ability to have a self-fulfilling prophecy around how you see things in your other markets, which are very similar, and
Yeah,
how inevitably there can be effectively a forward warning around how a certain company has to deal with a few things. I think a lot of times that sort of inability for investors and founders to really sort of match together and
for sure.
not think of it as a commoditized relationship, but effectively as a partnership of not necessarily equals, but I would say largely a partnership of well-meaning people that are implicitly aligned with
Yep.
regards to the end.
Yep. No, absolutely. So I think you look at it from different perspectives. So like in any relationship, you're so I think as it relates to VC, my first 2 to 3 investments that I made that we still are investors in, largely kind of impacted the way I found interactions with founders to be the best. Because basically was very lucky that they are 3 extremely high grade people. They're just people that I would be proud to be associated with, right? And the nature of the kind of working relationship that we developed was that um, I could call them at any time, they could call me at any time, and we would just try to be as objective and as productive as possible and as useful as possible to each other. That we didn't always have the answers, but collectively we'll figure it out. And that generally, because we have the benefit or privilege of being quite young still, that we sincerely and in earnest see it as a 20, 30-year relationship, right?
Yeah,
Why would you want to do anything else?
exactly.
Why, when opportunities are so clear, would you want to build a company for 5 years and sell it, or build a company for 7 years and then not know what to do with it, but have to have an answer that you have to have prepared for the VC? No, just say, look, I'm building a business for the next 20, 30 years. I want to do something that's truly enduring. And the nature of the relationship should be that. Now, the point, I think activism is probably a wrong word to use. I think what it's a bit more nuanced than that, in the sense that because the opportunities are clear, it's quite easy to see something that has product market fit, if you want to use that label, quite early. It doesn't require kind of you to understand rocket science to kind of just see that. It's pretty intuitive. Largely success rests on execution. Okay,
Yep.
the opportunity set is clear, right? The lay of the land is clear. There's a lot that you don't know. There's a lot that we will learn. Let's keep our eyes open. Let's be intellectually honest and try and solve everything rationally as they come, right? And not to say that we are the smartest, but we're doing this in a very focused manner. We're doing it a lot in many different places, in countries that are roughly at a similar stage of development, and we're investing in the similar type themes because they're the obvious opportunities, right?
Mhm.
And that maybe there is something that is useful in that, because we have the privilege of operating on a bandwidth that is broader than a founder, because the founder is 95% his own business, like 5% everything else typically, right? Um, we have the privilege of kind of seeing that on a kind of just data output level, but in a much broader range. And there are lessons to be seen from it, learned from it. Our job one of our jobs as a kind of as an investor is to try and synthesize that in the most useful way back to our founders in a very collaborative way. Because the point is that relationship is true partnership, right? There isn't this dynamic of I am the investor, you're the founder, I'm giving you money, now go work for me, right? It's just very dumb, that way of thinking. It's saying, look, our future is joined at the hip, right? I owe you as much as you owe me. If you're successful, I'm successful, vice versa. So let's kind of act in that manner.
Yep.
That's it.
I think that sort of brings us to what I've seen, at least in my experience in emerging markets, is that the stack of capital changes very, very quickly in terms of the requirement for the type of capital structure a company has to effectively use in the beginning is obviously very equity heavy, but there is somewhat of a larger opportunity in play for a lot of VCs when we think about sort of how do we sort of bring about anti-dilution sort of hedges within the capital structure of the business that we invest in. Because remember, when we think about a lot of these opportunities, they may be effectively opportunities which may be very slow burn opportunities, but they have effectively really great margins. And
Mm,
the way to sort of structure and scale them is not necessarily putting unfair expectations around how quickly you can extract from the market, while
mm.
the unfair extraction itself is largely um, a position where you are effectively doing it on a unit economics negative level rather than
No, I
effectively
get what
on.
you're saying, but what's the question? What's the specific question?
So I think in terms of how would you be excited around what's your sort of level of excitement around the opportunity to build custom stack of capital for a lot
Mm,
of the businesses that we see, right?
right.
Going beyond effectively just, hey, we're equity investors, we're gonna do X, Y, and Z, and then let's go about it.
Yep, yep, yep. Um, okay, so kind of a few pieces of context. So I really hate kind of labels as a concept, right? So I've always found it awkward to kind of try to describe what we are, because we do VC. It's kind of a core of what we do. We also have a private equity practice, and the two may seem unrelated, but the way I see it is you need to understand the nature of an investment management firm's business. It's very important that founders understand the nature of what our business and every other investor's business is like, right? And just think of it through simple maths. Is if a firm manages 100 million, so to speak, typically they take 2% a year in management fees from that. their responsibility is to use that 2%, in this case 2 million a year, which will be fixed for 10 years, in building out a level of infrastructure that is fit for purpose for what they're trying to invest in, right? Okay. The problem is 2 million doesn't get you far if you want to build a very good infrastructure, right? It builds you a good infrastructure for a very specific purpose if you're very focused, but you cannot build a very strong infrastructure. Now, the problem in VC is that it's a game that doesn't scale well, right? Especially in emerging markets at this stage of their development. Meaning, if I went the simple maths again, it's useful for listeners to understand this, is if I'm trying to 5x, let's say a 50 million fund, okay, and assume that I own 10% of every underlying company, right? To 5x that, those companies collectively will need to be worth $2 billion at the end of the 10 years, at the end of the fund's life. Okay, that's what investors in theory should be willing to underwrite. You have to be able to prove that you can do that. Okay, 50 million is roughly the right size for the set of countries that we're talking about, in my mind. Where the markets are at this stage, it will be more, the requirement could be more going forward. But the problem is, on 50 million, that would imply $1 million a year in revenue. You can't still build out a very good team, a very good infrastructure. The reason I talked about in your first question as to where is the continuous opportunity set it's also in private equity. The benefit of private equity is, as opposed to us, where in VC we write $3 to $5 million investments, in private equity we write $40, $50 million investments. It allows us to operate at a scale because the IRR expectation from our investors is much lower, and we know we can achieve it. But there, for example, you do 200, 300, $400 million funds, right? That gives you a scale and permanency that you can then really build out a fit for purpose infrastructure for the collective of, in my mind, what we're ultimately trying to do is just be a little bit more efficient in how we allocate capital in emerging markets, because the history of it hasn't been too good, right? Whether that's in technology, we happen to believe that the foundational core of the future of these countries is technology and its infrastructure, for all the reasons that we've discussed. But we don't. But what effectively that implies for, let's say, technology companies, we say, okay, we invest early and we can invest up to 3 to 5 million to try and have around 10% ownership. And we, for our funds and for our continuous funds, will be able to continue to invest up until, let's say, Series B. But we will overwhelmingly work our arse off to make sure that there is a balance sheet, a coalition of balance sheet that we can access for whatever round is necessary, for whatever funding is necessary, to get you the funding to be where you should be, right? So that's why I mean, obviously it's just self-serving because I'm talking our own book, but I think that's what you need to go for. You need to go for a scale and a durability, right?
Yep.
And ultimately, what we're trying to kind of solve for is what are the most strategic, important assets in these countries to build and own for the next 20, 30 years, right? Whether we invest in that through VC funds, PE funds, co-investments, as long as we have access to balance sheet to do it, that's really what, I guess, ultimately what I like to think that we're trying to solve for.
Yep. I think that sort of brings us to how do you sort of think about the market as it is today and how it was when you started investing in the VC asset class, right? So if you were to look at the Iran fund, and then if you look at our newest fund, how has the market sort of changed in between, and then sort of rechanged again, I think, to an extent as well.
Yeah. So Iran was a very unique case. I mean, it's basically in Iran, we started in 2016, and in total we invested around $5 million to start 2 companies. Where, let's say, we were founding investors. There was a co-founder that largely was operating CEO. I was doing 80% of the work, and we did what was helpful to get the company up and running. Then brought it the investors to kind of, again, give it a permanency, 2-3 years of runway to kind of run. And on that 5 million invested, and one is an auto vertical, and the other was financial supermarket, right? In online insurance sales aggregator. We built kind of 2 businesses that today do about $120 million in revenue, and the category leaders, profitable, so on and so forth. That was a very unique view and a unique insight, because basically we didn't have competition, because ultimately sanctions came on the country. And that what we learned was actually in the intervening years, we experienced 80% currency devaluation, right? I mean, shit got crazy. But largely the companies, because they were operating in large areas, and their models were just much more efficient, and so on and so forth. Even in those years, they were growing revenues at least 1.5x in dollars year on year. Okay, that's quite interesting. And you say, okay, deep market can monetize throughout the cycle, can grow throughout the cycle, but if managed deliberately, right? That was the heuristic overwhelmingly from that experience that we took away. And then you go into saying, okay, I'm implementing this model in a handful of more countries. But that was like supercharged. And I was like, what is going on here? There's just money floating everywhere. Any which way people were getting funded. And it's unfortunate to see, and it's easy to say this after the fact and trying to sound like, oh, of course, you're in the game, you see that it's going on, you have to play the game. I mean, it's you try not to do stupid stuff, but you can't be out of the market not investing. But a lot of stuff that probably shouldn't have been funded got funded. I mean, it's just, but this is the nature of the game. I mean, again, if you're playing a 20, 30-year thing, there are cycles. Liquidity will come, liquidity will go. The economy will go up, the economy will go down. At some point in the 10 years, you'll have some form of political crisis or an economic crisis. Probability entails that will be the case. It's perfectly fine that it happens. Just be prepared for it. Like, create your business to be prepared for it. It's just, you can't fool yourself into thinking that, yes, in your presentation, the slide shows kind of a linear GDP growth rate, a linear kind of, the reality is not that. Don't fool yourself to think that is, and don't build your models to think that that's what it's going to be. Don't fine tune your, just prepare for the reality of what it is. Right? Try to have liquidity always. Try to understand base level economics. What does it take to get your company base level profitable? And how do I build up an analytical dashboard across everything that I need to optimize to know how to tweak it through the cycle and manage your liquidity effectively, right? When times are good, as they were the past few years, be aggressive, get liquidity on your own terms, the best terms that you can. And that doesn't mean very high valuations, by the way. It means finding the best investors, right? Because high valuation basically means you're setting a very high expectation of what you're there to achieve, and you're unnecessarily putting stress on yourself. It largely breaks companies. It doesn't make them better. But use those periods to find the best investors that you can find, and build up your balance sheet so that when inevitably things go a little bit difficult and your competitors go away, then you get aggressive and can consolidate, right? Not to step away when the whole liquidity in the market is going away. That's the time to step down and be as aggressive as you can, because that's really a time to consolidate. That's what I learned in Iran. You need to be you need to be prepared to be counter-cyclical in emerging markets, because if you can, and that cyclicality exists in high velocity, you will over a 10-year period just consistently gain market share, economically efficiently, and because you have distribution advantage, because you're technology native, you'll be a beast of a business. I would love to be an associate of any business like that. It's just cool to see. It's cool seeing it being built. It should be built, right?
Yeah, I think that's sort of where we think about, what it takes to build an exceptional business, right? It's one of the things that I like to look at in terms of when we're doing DD is sort of their product roadmap, their initiatives roadmap, right? Anytime I see sort of moonshot after moonshot after moonshot in terms of I'm going to do X, I'm going to do Y, I'm going to do Z, and these are all going to be like completely like, game-changing things. I generally get very, very nervous, because it means that every one of those initiatives has a high degree of capital requirement most of the time. And B, it also has huge amounts of bandwidth requirement where you're no longer focused on optimizing your business, but actually just scaling without having the real sort of ability to maintain experience over time. And really, when you have such little competition around you, you actually end up competing against yourself. And that competing against yourself is not necessarily you trying to outdo yourself every quarter, but largely how do you
You've made your
basically
you've made your life unnecessarily difficult for yourself.
exactly, and I think that's sort of where it drives down that capital efficiency route, right?
Mm.
Has your business model been proven enough? I think we talk about product market fit, but then we talk about business model fit, right? And do we have like a business model to market fit for a lot of the plays that we generally invest in? What
Mm.
we've seen is that we're always on the pathway to business model fit, and most of them do have product market fit. When you think about analytics, for example,
Mm.
we find that to be an extremely I think that's sort of like, our sort of red line at times in terms
Mm.
of you have the ability to really objectively measure your business and where it's going, and you have effectively the ability to then course correct in time, because
Yep.
I think it's not necessarily that the action isn't taken, um, or the right action isn't taken.
Yeah, yeah, yeah.
It's
Look,
just,
I think a way you could frame it is I believe if you just did this, it would be enough to kind of do well.
yeah,
One, survive, right? Don't die. Just don't die. Okay. Two, continue to build distribution. At even break even is good enough.
yeah,
Build distribution even if it's break even. Make sure that you're knowing more about what it is that you're doing, right?
yes,
Because the reality is you are learning much more about the reality of what it is that you're trying to challenge. There is
yeah,
no kind of all-seeing founder. There is no all-seeing human. We have hypothesis, we test it versus reality. We have to re-underwrite and again and again and again, right? But have that process intellectually actually ticking. Be honest in that.
yeah,
Moonshots don't do that, right?
yeah,
The nature of you has to be ambitious
yeah,
because it's audacious. You have to be bold. It's great. It's beautiful to see it. Be that, but be sensibly audacious, right?
yeah,
Survive, build distribution, break even, and try to build a little bit of product at a time. You will already have a significant business in 10 years. That's the bar. That's what I'm saying. This is what I try to explain to investors. It's not a high bar to build something meaningful, right?
yes,
Now, if you then just so happen to be like an optimization machine, right, and truly be fine-tuned to what the reality of it is going on, how to build out kind of a system of logic, because really what you understand at the end of it, the core of a company, a successful company, is the most efficient coordination system. Great companies are great coordination systems relative to a certain aim that they're achieving, right?
yeah,
You are coordinating human capital, technology, whatever you want, within a certain system to run and scale, right? Now, the point
yeah,
is that whether you are explicit about it or not, there is a system, right? And it's better to be deliberate and explicit about it, but focus on what that system is, because that's the thing that scales. That's the thing that investors back. They do not want to back founder heroes, right? Because no heroes exist.
no,
Great people exist, but they're etched into it, right? They're etched into it.
yeah,
They weren't born that way. So don't try to go for moonshots because it's not necessary. Just be sensible. It's the opportunity is just so clear in my mind, and it's yeah, yeah.
yeah. I, so I think interesting questions come out where they're speaking about how do we normalize failure amongst Pakistani startups, which is sort of an
Ah,
antithesis
yeah.
to like,
Yeah,
what
yeah,
we're
yeah. So
talking about.
look, I think this is well. Look, the problem is like everyone is harsh on their own country,
Yeah,
and it's just a bit silly to be that way, right?
yeah,
Um, just look. What is it? What is the essence of happening? An ecosystem is forming. There are
yeah,
success stories. There are failures. Some companies fail at a larger size, right? Some
yeah,
companies are the ones that got funded the most, and then they fail. Some companies fail very early. What
yeah,
it just abstract out that these are companies and just look at it as capital going in to learn how to be deployed in an efficient manner to build efficient things on scale. Abstract out the people, the characters, the companies, abstract all of that out and just see it as a learning system for that
yeah,
and try to push that learning system forward, right?
mm,
And effectively, this is what I think Ali and Pack launch is.
yeah,
It's the
exactly.
most honest form of trying to build an ecosystem, right? And it's very easy to be cynical. It's very easy to dunk on people that have made mistakes. I mean, what's the point? I mean, we have companies that fail. Statistically, they will fail. There will be companies in our portfolio. Not that we're trying to optimize for failure. Shit happens sometimes, right? Largely, if the people behind those companies, we ended up objectively being decent, smart people, we are the first people to try and find a way to work with them again. Because we just say sometimes shit happens, kind of bad things align at the same time. Not that people shouldn't dissolve themselves of responsibility. Your responsibility is to analyze it vigorously to understand what went wrong. What went wrong and why. Synthesize that very well. Yeah. And then move on. That's it. If anyone says something stupid about you, forget it. Just get on with it. Just put your head down and get on with it. Shit happens in life. I think it's fuck.
Yeah. Well, I think that's sort of so I'm sort of pivoting into questions because we're a little short on time.
Yeah, sure.
But
I'm happy to
yeah,
go on, by the way, but I mean, I don't know about the audience.
yeah, no worries. In terms of so I think maybe a few questions about us, right?
Yeah.
So a few questions about us are generally that. Oh, okay. Um, guess what's our ticket size? What do we help with besides capital? How do we pitch to you? What are you looking for right now? Which market sector you're most bullish about?
To take it one by one, that'll be gonna answer all this.
All right. Well, okay. So why don't we just do our sort of intro at this point in time that we do almost on every founder call, where we tell people what we're generally interested in investing, and how we sort of look at opportunities and founder sets, and why we think that there are specific why we think we bring something unique to the table, beyond capitalism.
Yeah, sure. So I kind of tried to articulate it a bit earlier. What I think that simply we try to be is not a VC, not a P. Just think of it as an investment holding. Not trying to use the term holding to sound grander than what we are. It's just the simplest word to use. Where ultimately what we want to be in 20, 30 years is kind of significant equity owners in some of the most important, durable businesses in the countries that we're in, right? We're here to break bread for the next 20, 30 years. And so we view it with that lens in terms of the nature of the partnerships that we have with founders. I briefly touched upon it earlier. And that entails that we just want to be with the best people doing the best things, right? And I like to think that we have a level of infrastructure because we do both PE and VC, that we get to hire great people like yourself, for example, right? We get to have an infrastructure in London. We get to have an infrastructure locally in countries. We get to have people that have built significant businesses before in many different verticals, from banking to be on our team. Where, if I try to simply define it, what we're trying to reduce are stupid mistakes, and to optimize where possible, right?
Yeah.
And to hopefully be an objective voice of reasoning.
Yeah.
And that through earnest kind of endeavor, by doing this in many countries at a similar point in time, that actually we are sitting on a very unique data set. So I think actually in some countries like Uzbekistan, we probably have more credit data than the credit bureau of the government itself, because we're proactively understanding that we are building very unique data sets through our companies, and not that we're using it for kind of nefarious reasons. What we're trying to use it as objective kind of synthesis of what the hell is actually going on, to drive hopefully good decision making, right?
Yep.
For ourselves, for our founders, for everyone else. Clearly, in these markets, liquidity is much more volatile, and as we're seeing right now, is much more cyclical than a lot of markets. And so, as I said, we need to have permanency of balance sheet to be able to provide to companies, whether it's our own or that of kind of co-investors or people that are trust us with their capital. So that hopefully we can ensure that if a company earns the right to it, it doesn't really have to worry about having liquidity or oxygen to kind of do what it's doing. And that generally we see it as a long-term partnership, right? Generally, it's a long-term partnership. I hope that there will be a day where people that we invest with, we're old and we look back on what has been built, because that just would be a very cool thing to do, right? Now, where do we invest? The nature of how we invest in our funds, we don't invest in any more than 15 to 20 companies a fund. We like to own somewhere between, in some cases, I mean, the ideal is around 10%. In some cases, we own up to 25% of businesses. Those are usually cases where we've kind of started it alongside a management team from scratch, where by virtue of starting it early in what if in effect is a greenfield opportunity, you have kind of a much larger ownership. But for minority stakes, which is usually the companies, the cases with which we invest in, we like to own up to 10%.
Yep.
And typically pay somewhere between 5 to 10 million for that over the life of the company, right?
Yeah.
And I could go into all the different verticals. What we really care about are objective, smart, high energy people building stuff that they understand distribution and they understand how to build. I mean, we see the maths as something like this. We believe there are models where your CAC can be $10 or your CAC can be $5 with pretty good retention. Okay. Now use a very, very simplistic, non-realistic assumption of saying you have 100% retention and you have $5 CAC. That implies that you spend 5 million to build a million users. Okay. Again, assume 100% retention, but this is kind of a make-believe, but just to articulate it. If you understand how to extract $100 to $300 per revenue per user per year, right? You're sitting on $100 to $300 million revenue business. If you can run that business at 20 to 40% operating margins, right? And when I say revenue, I mean net revenue, not GMV, net revenue. If you can run that on 20, 40% operating margins, okay, you're sitting on probably a 300 to 500 million dollar business in times like today, and certainly a 700 million plus business in times of yesteryear, which may come back whenever that comes back. Don't expect it to be the case, but right. So if you just run the simple math like that, that's really what we're trying to look for. Who understands distribution? Who understands how to extract revenue from the distribution? With the overarching aim that they're trying to build pretty better systems than what exists in the country to run things more efficiently, to solve real pain points. Yeah.
Yeah, I think so. On that note, what we can sort of conclude a little bit is really when it comes to sort of our investment philosophy and everything like that, it's largely about being in it, being there for the long term.
Yeah.
Being partners, not necessarily just investors.
Yeah, I mean, to kind of be very specific on that, I mean, our LPs, they, like any LP would always ask is, what about exits, so on and so forth. And I go through my kind of spiel of what about exits. I don't need to repeat it here. But what I do say every time is myself, we monetize through carry, right? We get 20% of upside. Myself, I will always be on the side. I want to have equity in whatever the company is, right? I don't really want to invest in a company that has to create some sort of arbitrary liquidity events in 10 years just so I can get cash back out to my investors. I will do my fiduciary duty to make sure that I can get the cash back out to my investors. But personally, I will be on the side of equity because I want to be a partner to these people, to these founders for the next 20, 30 years. Why would you want to be in business with people that you wouldn't want to be in business with for 30 years? Right.
It's hard enough to
and why would I want to try and make it difficult for myself to keep finding what is kind of statistically tough to find?
Hard enough to find one.
Right.
Yeah,
so
exactly. Yeah. So I think we had a great time sort of talking here on POC Launch. Thank you, Ali, for organizing this again.
Yeah.
And for all the listeners and viewers, you guys can always reach out to us, the POC Launch community. We're quite open to sort of talking to everyone. Every investment case is case by case basis. So effectively what we review is generally down to our own internal committee and our understanding of how we sort of see the opportunity going forward. But every opportunity also is a learning experience for us, and our views may change largely based on the execution and the evidence that's presented to us. So with that, thank you, Kiyan, and thank you everyone for tuning in. Have a great evening or morning, wherever you guys are.
Thank you so much. Ali, thank you as always.
Thank you so much. Look forward to seeing you in London.
Take care, sir. Bye.
Bye-bye.